Hey everyone, welcome back to Paye4U, UK, Payroll Made Simple. Today we're diving into pensions, what they are, how they work, and why you see them on your payslip. But before we get started, I just want to say a huge thank you to all of you who've been supporting my channel. Every like, comment, and subscription honestly means so much and keeps me motivated to make payroll simple for everyone. So, thank you. Now, if you've ever looked at your payslip and thought, why is money going out for pension? Don't worry, by the end of this video, you'll know exactly why it's deducted and why it's actually a good thing for your future. So stick around till the end. Alright, so what exactly is a pension? Think of it as a savings pot for your retirement. Instead of just relying on the state pension later in life, you and your employer put money aside every month into this pot. On top of that, the government usually chips in too, through something called tax relief. Basically, the more you put in now, the more comfortable you'll be when you stop working. Now, there isn't just one type of pension. Let's break them down. Workplace pension. If you're employed, chances are you've already been automatically enrolled into a workplace pension by your employer. Don't worry, I'll be covering this in more detail shortly. Next, personal pension. This is if you're self-employed, or you just want to save a little extra on top of your workplace pension. You can set up your own personal or private pension plan. The good news is, the government still gives you tax relief on your contributions, which helps your pot grow faster. And finally, there's the state pension. This comes from the national insurance contributions you've built up over your working life. Right now, you usually need at least 35 qualifying years to get the full amount. The current full new state pension is £230.25 per week. But if you reached pension age before the 6th of April 2016, you might be on the basic state pension, which is £176.45 per week for the 2025-26 tax year. If you'd like more details, I've dropped the official link in the description, so make sure to check that out. Alright, let's talk about auto-enrollment. If you're over 22, earning more than £10,000 a year, and working in the UK, you'll normally be automatically enrolled into a workplace pension. At the moment, the minimum total contribution is 8% of your qualifying earnings. That usually breaks down as 5% from you, which already includes tax relief from HMRC, and 3% from your employer. Now, here's where it gets interesting. Not everyone realizes there are actually a few different ways pension contributions can be taken from your pay: salary sacrifice, or salary exchange. You agree to reduce your salary by the amount you want to contribute, and your employer pays it straight into your pension. The big win here, you don't pay national insurance on that amount, so you keep a little more in your pocket. Net pay arrangement. Here, your contribution is taken out before tax is worked out. That means you automatically get the full tax relief, even if you're a higher rate taxpayer. The only catch is, if you earn under the tax threshold, you won't get the extra government top-ups. Relief at source. With this method, your contribution is taken after tax. Then, your pension provider goes to HMRC and claims back 20% tax relief to add to your pot. If you're a higher rate taxpayer, you can claim even more back through self-assessment. So, when you check your payslip, you might see something like EE pension, that's your contribution, and ER pension, that's your employer's bit. Or, if your employer uses salary sacrifice, you might just see salary sacrifice instead of a deduction. So depending on which method your employer uses, it can look a little different. Okay, so what actually happens to the money in your pension? It's not just sitting in a bank account doing nothing, it's invested, so it can grow over time and hopefully give you more money when you retire. Now, you usually can't touch your pension until you're at least 55, and that age is going up to 57 in 2028. So why does it matter how your contributions are handled? Each method has its ups and downs as per your pension scheme type. Here's the thing, pensions might not feel like a big deal when you're younger, but trust me, future you will thank you. The earlier you start, the more time your money has to grow, and if you opt out of a workplace pension, you're basically turning down free money from your employer. So next time you see that pension deduction on your payslip, remember, it's not money disappearing. It's your future savings, topped up by your employer and boosted by the government. And that's pensions explained in a nutshell. If this video helped clear things up, make sure to hit that like button, share it with a friend. Next week, we'll break down student loan and postgraduate loan deductions and show you how they affect your pay. Thanks for watching. Remember, this video is for educational purposes only. It is not financial or legal advice. For personal queries, please contact HMRC or a professional advisor.